Hello. All right, we're ready for chapter 2. And so chapter 2 will not take as long as chapter 1. I say that, and I hope I'm right. So these are the chapter 2 lecture notes. You'll get those directly out of your Moodle shell. And so I'm still working on your Moodle shell. And so as we get ready, we'll review a little bit and we'll learn some new topics. And so I'm excited. So first thing to go through, this chapter is going to focus on items from the balance sheet. So what we're looking at here is different items, and we're going to learn how to compute the numbers rather than the numbers just being given. So we just finished chapter 1, and as we look at chapter 1, we see that the numbers were all just given to us. So assets are, this is a little bit of review. Assets are items owned, while liabilities are amounts owed. Those words look very similar, but notice that assets are owned and liabilities are owed. Also, as far as cash flow activities, we're going to focus almost exclusively in this chapter on investing and financing transactions. So just to review, I've said this lots of times in your notes and in your videos and things like that, but investing, you can invest in yourself or you can invest in others. So investing in yourself is through purchases or sales of long-term assets. We usually say PPE, property, plant, and equipment. And then investing in others is the things you think of as investing, like buying stock in McDonald's. Financing is owners. Sorry, when I did that, I made it put down a row. But owners and loans, okay? So owners and loans. So we're going to focus on those kinds of activities in this chapter. Your book, which you don't really have a book anymore, so it's just like accounting textbooks in general, focus on equity financing and debt financing. So if you're going to finance your business, if you're looking at how to finance your business, you can do it through debt or owner's equity. Okay. So as far as accounting goes, just some things to keep in mind. As accountants, we like to document everything. All right. So you guys shouldn't be surprised about that. Should not be a big shocker. We like things to be organized. We like things to be properly calculated. So we document everything. And so every transaction has a give and a get. So we receive something and we give something up. So as an example, I need to go to Walmart after I get done making these videos, and I will give them money and they will give me ketchup. Okay. So it's an exchange. All right. And then we're going to use dollars for the exchanges because our unit of measure is dollars in the United States. So this blank is the historical cost concept. Okay, so the historical cost, we could put principal instead. It doesn't matter, same thing. So the historical cost principle basically says that we will record everything as what we paid for it. And that's because that's the number we can document. We like to document. So we have a receipt and it says, I bought land worth $12,000. I paid $12,000. You do the transaction for $12,000. Okay. Another thing that accounting books often differentiate between are external and internal exchanges. I don't really focus on that, but an external exchange is when you do a transaction that involves people outside of your business. Like if you get the owners to give you money, or if you go to the bank and get a loan. And then internal events are within the business. And so, again, I don't really focus on that. One thing to point out, exchanges of only promises are not considered transactions. You actually saw that in the very first chapter, in that very first introductory activity. Do you remember Jack's dad said he'd buy us a Porsche, or he'd buy Jack a Porsche if he did good in accounting? And we were like, we're not going to record that. We're not going to put that down because it's a promise for a future event and we don't know if it's going to happen. Okay, so the next topic is talking about duality of effects, which just means that every transaction that we look at in accounting is going to affect two things, and that's going to keep our accounting equation in balance. So here's our accounting equation again: assets equals liabilities plus owner's equity. And what we're going to do is every single transaction we do, we're going to keep this equation in balance. And so that's why every transaction will affect two things. So we're always keeping it in balance. So the next thing is the chart of accounts. The chart of accounts is just a list of accounts that businesses can use. So like my accounts might be cash and accounts receivable and land and buildings and equipment and supplies. I don't know. So I just made that up. Those are my assets. And then I might have accounts payable and notes payable. So every business looks different and you can have your own chart of accounts. It's specific to you. So if you're a doctor's office, then you might call your revenue client revenue. But if you're a construction company, you might call it like, you know, housing revenue or commercial revenue or whatever, if you're building a commercial building. So you can name them whatever you want. Okay, so the next thing we're going to do is on this page, we are going to go through and we are going to start learning how to record transactions. Now, so this is what this whole page looks like. And so as we fill out this page, I want you to keep in mind that like this list of 5 questions, I don't usually do this, but a lot of times in accounting books, they do this for every single transaction. I feel like it's overkill. So every time we look at a transaction, so the first transaction says stockholder invests 10,000 into the business. They're like, okay, does a transaction exist? And I'm like, yeah, something happened. Like there was an exchange. Examine it for accounts affected. And then we're like, okay, what 2 accounts are we going to use? And then what kinds of accounts are they? And did they go up or down? And is the equation still in balance? I think this is a little bit of overkill to do this for every single transaction. So I don't. But I'll do it once just so you can kind of see. So stockholder invests 10,000 in the business. And so what we're going to do is we have a little spreadsheet to keep track of our different transactions. And so we have transactions A through I. So we are going to learn how to record transactions A through I. So as I'm looking at these, I've got cash, supplies, equipment. And so I have 3 different assets. That means that this business only has 3 assets total. Okay. Now, as the business grows, we might add another column and we may have like land, or we might have accounts receivable. But in this situation right now, we only have 3 assets to work with. We have 2 liabilities, and then I only have common stock. And that's because this business isn't going to have any revenues and expenses yet. So there is going to be no retained earnings yet because it's its very first year of business. And so retained earnings is 0. Okay, so what we're going to do is we're going to look at each transaction, and remember the duality of effects. Every transaction is going to affect 2 things. So we are going to have to put each transaction in 2 places to keep everything in balance. Our accounting equation is listed at the top. Assets equals liabilities plus owner's equity. And normally there's 2 kinds of owner's equity, but right now we only have 1. Okay, so all right. Stockholder invests 10,000 in the business. So does a transaction exist? Yep. Examine it for accounts affected. So what we're going to do is we're going to go down here and we're going to identify what 2 columns that we want to use. So the stockholders are going to give us money. We have money and they have owner's equity. So the 2 accounts that we're going to use are going to be, and normally I would ask you guys and you would tell me, but you can't tell me because you're not like talking to me in this video. So we have cash and we have common stock because the owners invested money in the business. So we're going to say cash and common stock. Classify each account. Cash is an asset and common stock is an owner's equity. Identify direction and amount. We're going to receive 10,000 in cash, and owner's equity is also going to go up by 10,000. Ensure the equation still balances. Okay, so if assets equals liabilities plus owner's equity, then we would say 10,000 equals 0 plus 10,000 because there was no liabilities in this transaction. And so assets are going to go up by 10, liabilities go up by 0, and owner's equity go up by 10. So yeah, we're still balancing. So we're not going to do that for every single transaction because, again, I think that we're going to talk through it and we're going to put it in our table. So what we're going to do is we're just going to go down here. We're going to say cash plus 10,000 and common stock plus 10,000. Okay. And then we're going to go on to our next transaction. So we can see our accounting equation in balance because we put positive 10,000 on the asset side and we put positive 10,000 on the liabilities and equity side. So 10,000 equals 10,000. Okay. Okay. So I'm going to real quick, like pause. Okay. So the next transactions have borrowed 15,000 using a note payable to the bank. So we have 10,000 cash that we got from our owners, but now we're going to walk over to the bank and we're going to be like, all right, we have 10,000 to work with, but we need some more money to start our business. And so can we borrow 15? And they're going to ask us a lot of questions, but let's say it happened. Okay. So we borrowed $15,000. And so we need to look at the accounts that we have available to us. Cash, supplies, equipment, accounts payable, notes payable, and common stock. And we have to figure out where to put that 15,000. So we need to put it in two places. So we're going to receive 15,000, but we have to pay it back. So that will be a notes payable. So what we're going to do is we're going to do plus 15,000 here because we're going to receive another 15,000. And then we're going to do plus 15,000 here. Now, I can't let you guys ask questions because you aren't here to ask me questions, but students often ask, like, why isn't this negative? Well, the loan went up, the liability went up. Later on, if we were to turn around the next day and pay it off, then we would do minus 15 and minus 15, and then the balance would be zero in the loan. But right now, the liability itself increased. Sometimes students ask, like, well, why didn't you put anything in common stock? Well, right now, like that only money from owners goes in common stock. Only money from owners goes in common stock. And so right now I have total cash of 25,000. If I were to decide, you know what, I don't want to be a business anymore, this is a stupid business and I'm out, then I have 25,000. I would have to pay back the bank 15. So I would give the bank 15 of it and the other 10 I would give back to my owners. And so assets 25 equals liabilities of 15 plus 10 of equity. So I'm in balance and everything is good. Let's do the next one. Acquire a $15,000 truck and $5,000 worth of equipment, paid cash. Okay. So I bought a truck and some equipment. I don't have a column that says truck, but truck is basically equipment. So basically what I've done is I have purchased a truck and some other equipment for 20,000. So I paid 20,000. So the two accounts I'm going to use, I paid 20,000 and I bought equipment. So I'm going to do cash plus, minus 20,000 and equipment plus 20,000. Now students are often like, well, what about owner's equity? The only thing that goes in owner's equity in the common stock column is when the owners give us money. Right now, all I did was give up some cash to purchase another asset. So this is called an asset exchange, is what books call it. And so what we did was we traded one asset for another asset. And so you'll notice that I didn't put anything over here. I didn't go get a loan. I didn't borrow any money for this transaction or anything. So all I did was minus and plus on the same side. Now, when I did that, minus 20 and plus 20 on the same side makes 0 on this side. So I have 0 on the asset side and I have 0 on the liability and equity side. So I'm in balance. Okay, next letter D, purchased 300 worth of supplies on credit. So I'm going to go buy some supplies, but I bought them on credit. We've never used that term before, so I'm defining it. On credit means so you're going to receive the supplies now, but you're going to pay later. Pay later. We've heard that term before, pay later. So in this situation, I bought supplies, so I know that supplies is going to go up. I bought supplies. And I'm going to pay later. So I need to use either accounts payable or notes payable. And now this is when students often ask, like, well, how do you know which one? Notes payable is usually a bank, and it usually involves interest. So regular transactions, we're going to use accounts payable. And then again, students ask, why plus? You didn't pay, like, why is it going up? Well, the liability is going up. Later on, when we pay for those, then we will minus, okay? But right now, all I've done here is I received supplies and I'm going to pay for them some other day. I have plus 300 on this side and plus 300 on this side. So I am in balance. Okay. So letter E, sign contract for first website design, 10,000. Okay. Okay. Well, I guess now I know what we do for a living, because apparently we've been accumulating money and we bought a truck. Why did we buy a truck to design a website? Whatever. So I assume my other equipment hopefully was a computer, maybe like other like computer equipment. I don't know. But we're going to design websites. So did I receive $10,000? I think that a customer came and found us and they're like, what up, Nicole? I'm like, what up? And then I'm like, I design websites for a living. And they're like, I need a website. And I'm like, $10,000. And so, so they agreed to let me build a website for 10,000. But this is a promise for a future transaction. Nothing actually happened in transaction E. I don't have any money. They didn't give me any money yet. If I'd asked for a down payment, then I'd have a transaction, but I didn't because I don't know to do that yet. And so on letter E, no transaction. So you can just leave it blank. I usually write like nothing right there, just so that you don't think you forgot to write it down. Okay. Because sometimes students will like text me later and they'll be like, you forgot to do transaction E. And I'm like, oh, it's nothing. Like it's not a transaction. So, okay, letter F, company pays off the 300 in accounts payable. Okay, so now we owed that money to that supplier. We bought those supplies on credit. We're going to pay it off. So we need to pay 300. So again, I need to know what two accounts to use. So when I'm looking at what two accounts to use, I'm going to say I paid 300. I like cash. Cash is my favorite account because I always know what to do with cash. So I'm going to pay 300. And then students are like, well, yeah, don't you just minus the 300 in supplies? And the answer is no, I still have those supplies. They're assets to me. I still have them, but I'm paying off the accounts payable. So I no longer owe the accounts payable. Now my balance in accounts payable is 0 because I borrowed, I charged it. I did that on credit on account, and then I paid it off. So I paid 300 in cash and I paid off the accounts payable. Students want me to put something right here. It doesn't even, I don't even identify like what the accounts payable was for. It could have been for other stuff. It didn't even have to be for supplies. It could have been equipment or whatever, but I paid 300 cash. So minus 300 equals minus 300. Okay, now we're going to pay for and receive 600 of supplies. So now I guess we have a different supplier and they don't let us charge it. And so we are going to pay 600 for supplies. So we gave up cash and we got supplies, an asset exchange, one asset for another. So the minus 600 and plus 600 cancel out over here. Nothing goes over here. Those supplies were not on account. And again, we didn't get money from owners. And so nothing goes in common stock except money from owners. Okay, letter H, acquire and receive 1,000 of equipment. We received equipment and we paid cash, acquired and received. It didn't say on account. It didn't say on credit. So there's that. Letter I, lawnmower. Don't we build websites? Man, we don't operate a very good business, okay? But apparently we're ordering a lawnmower. When we order a lawnmower, did we pay for it? It doesn't say acquires. It doesn't say pays for. We just ordered it. So this is not a transaction, okay? Because we don't have the lawnmower yet. So we don't have an asset yet. We can't put it in equipment until we receive it. And we didn't pay for it. So if it said we paid for the lawnmower, then we have to do something. But right now it just says orders. This is a promise for a future transaction. That one is nothing. Okay. So at this point now we have all of the transactions recorded in our table. Okay. So what we're going to do is we're going to go ahead and check and see if we balance. Now every transaction balanced. So we should balance at the bottom, but we are going to go ahead and check this and make sure that everything is okay. So what we're going to do is we're going to add up this whole column. Now, some of them I don't have to get out a calculator for. I see this one, it's 900. I don't have to add it up. Like I don't have to get a calculator out to say 300 and 600, but cash I kind of do. Okay. So I have 10,000 plus 15 minus 20 minus 300 minus 600 minus 1,000. Looks like I've got 3,100. Okay, and then here I have 900. Here I have 20 and 1, so I have 21,000. Here I have plus 300 and minus 300, so this one looks like 0. This one I just have 15,000, and this one I have 10,000. So at this point, I'm ready to go do a balance sheet. I could go do a balance sheet, just like you guys did in chapter 1, where you had all of your assets and your liabilities and equity. And so in your assets, we had to have 3. We have 3 assets: cash, supplies, and equipment. We have 3,100, 900, and 21,000. Oops, 3,100 plus 3,100 plus 900 plus 21,000. So we have assets of 25,000. If we add these 3 numbers, it's 25,000. And if we add these 3 numbers, it is also 25,000. So we are in balance. So we would do a header, a who, what, when, and would use these totals to go ahead and record that, that our balance sheet is in balance. Okay. So at this point, you're ready to do the first tab of the chapter 1 homework. So you guys can go off and go do that if you'd like to, based on this system of recording transactions. But I want to point out to you guys, because I'm going to go ahead and keep going with the notes, that this isn't really practical, because in a business, you don't have 3 assets to keep track of. You might have 100 assets to keep track of. And so that would be a lot of individual accounts. And then we would also have revenues and expenses and dividends and all the other accounts to deal with. And so this system is not overly efficient. And so what we do is we're going to do something that we're going to learn about next. And that's the idea of doing them as debits and credits instead. All right, so let's move on to the next page. So most companies are going to use journals and ledgers to keep track. Now, a journal is something that you guys don't quite know about yet, but we're going to learn about it. And that's where we're going to keep track of all of our transactions. And so your journal is called your book of original entry, is what a lot of places call it. So what that means is it's the first place we go to record transactions. Okay. And so we are going to go record transactions in the journal, and then we're going to learn how to post to the ledger. The ledger is where we're going to have each of our individual accounts, and we're going to keep track of their balances. And so this is called the home of the T accounts. And right now, you don't even know what a T account is, but I'm about to teach you, okay? And so a T account is something that we as accountants use constantly. And so I want you guys to be comfortable with this new concept. So this is a day that a lot of times like a student will be missing in class, and they'll be like, oh my gosh, after this day, like they have no idea what's going on if they don't learn this concept of a T account, because we're going to do it for the rest of the semester. So today's lecture is very important. All right. That is a T account. See it? It looks like a giant T. That's why it's called a T account. And it'll have a title here. It might say cash, or it might say equipment, or it might say supplies, or accounts payable, or notes payable, or common stock. And then this side is called the debit side. The word debit means left. That's all the word debit means. Now, right now, you guys know about debit cards and credit cards and things like that. And you have this preconceived notion about how if you use your debit card, it does something to your account. And so if you debit something, like it means decrease or increase or whatever. In accounting, the word debit means left. It only means left. It does not mean increase. It does not mean decrease. It means left. It means put a number on the left side of the T account. Okay. And then the word credit means right. Okay. So earlier when I said you credit your account, like I tend to not use that language once we get into this debit credit situation because it confuses you. But in accounting, if you credit something, it means put the number on the right side of the T account. So what we need to learn is we need to learn the rules of debits and credits. And this is something that's going to take some time to sink in. And eventually it becomes second nature. My students just know what to do when I tell them that they receive cash, they know what to go do. But right now, you guys are going to need some time to figure this out. So we ease our way into it. So this, before I scroll, is the accounting equation. You guys all see it at the bottom of your screen, or you see it in your notes. So assets equals liabilities plus owner's equity. And that's the accounting equation. So if we're trying to memorize and understand the rules of debits and credits, if we know what happens to assets, then on the opposite side of this equation, it should be opposite. Because if you move to the opposite side of the equation, then you switch signs. So if assets increase on the debit side, if I put the plus on the left debit side, then that means that liabilities and owner's equity should have a plus on the credit side because they are on the opposite side of the equation. So that's called the mirror image approach. And so what I want to do now is you guys have this big open spot on the bottom of page 3. So what I'm going to do is I'm going to go out to a blank Excel and we are going to draw a picture right here. Now, I'm not going to try to draw it in Word because if I draw with Word and I have to use the draw function, it's really kind of weird. So I am going to draw it in Excel, but I want you guys to handwrite draw it here. Or if you're using the computer, you can go out to Excel and then we'll copy and paste it into here, okay? So I'm going to go out to Excel. And the first thing I'm going to do, because I want you guys to be able to see the lines I'm drawing and stuff, is I'm going to go to view and I'm going to turn off the grid lines. The grid lines are the little lines between each cell and I'm just going to turn them off so that it looks like a big open white sheet. Okay. So the first thing I'm going to do is I am going to draw some T's. So when I draw a T, I'm going to highlight 2 cells. And now this is me drawing it in Excel. You guys don't have to draw it in Excel. You're just going to draw a T. So I'm going to do 2 and then do a right border. So I just drew a T. And now I'm going to do that. I'm going to do 4 across the top. So what I want is these 4 drawn on your sheet across here. And then I want you to draw 2 more here. And then I want you to draw 1 more below there. So now what I have is I have this as a picture. So I want you to draw 4, 2, 1 on your sheet right here. 4, 2, 1 on the bottom of page 3. And now I'm going to go ahead and label them. And the first one, now I want these to be combined, so I'm going to merge them. And then I'm going to do that on each one. I just want all those cells merged. Should have did that before I copied and pasted them. So the first account I'm going to label is assets. This one is going to be liabilities. This one is going to be common stock. This one's going to be retained earnings. And then this one's going to be revenues. Expenses over here and dividends over here. Now, these are all of the different kinds of accounts that we learned about in chapter 1. So on the very first tab of chapter 1 homework, when I gave you guys those choices, I was like, I gave you a list of accounts and I'm like, tell me if it's an asset, a liability, an owner's equity, a revenue, an expense, or a dividend. And you guys went through and you're like, marketing expense is an expense account. And then you said like supplies as an asset and accounts payable is a liability. So these are all the kinds of accounts that you know about. And this is going to be the case for the rest of the semester. So these are the kinds of accounts that you guys know about. So the next thing I want to do is I want to label the debit side and the credit side. So in every T account, the word debit means left. So debit means left and credit means right. And so basically, this is the debit side and this is the credit side. And that's the case on every single T account. Now, accounting books actually abbreviate the word debit as DR. And I used to not know what that meant, but at some point, one of my students Googled it. And it's because debit doesn't have an R in it. So it used to be like, and they do, your accounting books will abbreviate debit, DR, and credit as CR. And everybody was like, there's no R in debit. And you're right, there's not. I'm like, so why do they abbreviate it like that? And that's because the Latin word for debit is debur. And that's why there's an R in the abbreviation of debit, but that's lame. So you can just abbreviated as D and C, I don't care. But know that debit means left, credit means right. The debit side of every single T account is the left side. So again, this right now should be written right here because you guys are going to need this like over and over and over again. So the next thing I want to do is I want to label the increase and decrease side of each T account. Now, again, this feels a little bit weird because you're like, why are we doing this, right? And so what we're going to do is we're going to learn how to record transactions. And this is such an important event that we're getting ready to do here. So the word debit means left. And if you can remember one of these, then you can remember all of the rest of them. Because we remember that this is the accounting equation along the top. Assets equal liabilities plus my two kinds of equity, common stock and retained earnings. I would also point out that in this chapter, we're only going to use these accounts. We won't use these until chapters 3 and 4. Okay, but I'm going to do all of them now because we're going to need it. So, all right. So if we can remember one thing, then we would say that assets increase on the debit side. Now hear my voice. Assets increase on the debit left side because debit means left. So assets are going to increase on this side. Oops. And so I need to put in a little apostrophe there. They're going to increase on this side and decrease on this side. So you can put a plus and a minus, or if you prefer to put increase, decrease, that's fine. But assets increase on the debit side. Okay, so that means if you receive cash, you will debit cash because cash is going up. If you pay cash, you will credit cash because cash is going down. So I want you to put the plus on the appropriate side, on the correct side. So assets will have their plus on the debit side. So on the rest of the accounting equation, it's going to be opposite. So if we come over here, you saw it here. So see how the plus is on the debit side. And now our plus is going to be on the credit side for liabilities and equity. So what I'm going to do, this whole row, and this whole row, I want them to be centered. So on liabilities, the plus needs to be on the credit side. I'm putting an apostrophe in front of it so it lets me have it. So I'm going to put the plus on the credit side for each one of these. So for liabilities, common stock, and retained earnings, I'm putting the plus on the credit side. And that's because it's the opposite side of the equation. Assets equal all of this. So the liabilities, common stock, and retained earnings plus is on the credit side. Now, eventually you're just going to like early on memorize like what side the plus is on, but I want you to know why, and that's why. So now all I have left is my red ones. And you like just pause and you're like, there's no red. What are you talking about? Revenues, expenses, and dividends, RED, these are my red ones. And we'll do special things with these accounts over time in general. And so now I need to put my pluses and minuses on them, and I need to figure out which ones have pluses and which ones have minuses. So basically what we look at, the reason why the pluses and minuses happen, revenue is good for the business. It makes retained earnings go up. Revenues, the business likes revenue, and it makes your retained earnings go up. Because remember, retained earnings, you increase by net income and subtract dividends. Beginning retained earnings plus net income minus dividends. Net income is made up of revenues and expenses, and revenues make net income go up. So the plus is over here. Oops. There we go. And the minus is over here. Okay, so revenues have their plus on the credit side. But expenses are the opposite of revenues, right? So their plus will be on the debit side. And then, because expenses reduce retained earnings, and so do dividends. Dividends make retained earnings go down because we do beginning retained earnings plus net income minus dividends. So the plus for dividends is also on the debit side. So I want you to put all of your pluses and minuses in. And right now that looks like a jumbled mess, and it doesn't look like we're really speaking English anymore. And we're looking at it like, I don't know what this is, but don't worry, we're going to use it and it's going to make sense and it's going to be good. So just be patient with me. Okay. The last thing we're going to do is we're going to come up with the balance in each T account. So what I'm going to do is I'm going to draw a line across the bottom. So I'm going to draw a line across the bottom of each one of these T accounts, a nice bottom border. So I'm going to draw a line across the bottom of each T account. You're doing this in Excel, good job, because I know this is kind of a pain. It's the easiest way for me to do it because I don't have one of those drawing devices to show you guys stuff. And now we're going to write the balance on the appropriate side. So I just did a bottom border all the way across these to go ahead and give you guys the border. And then I need to put the balance on the correct side. So the balance is always on the positive side. So if we look, the plus is on the debit side for this one, and this one. Okay, these three accounts have their plus on the debit side. The other ones have their pluses on the credit side. So I'm going to go ahead and just make them a color so we can see them. Okay, and so on those, our balance will be on the debit side. So that's where the balance will appear. Whereas the other accounts will have their balance on the credit side. And then each one of the balances needs double underlined because that's what we do with the balance. When we have our answer, we will give it a double underline. So give it a top and double bottom border so that each one has a double underline. Okay. All right, so the next thing I want to point out just in general is ADE have debit balances. ADE, assets, dividends, and expenses have their plus on the debit side. Okay, so what I'm going to do, because I can now, is I think I'm going to just take a screenshot of this. And then I'm going to try to paste it into here. And then I just need to make it small enough that it fits into that spot up there. Okay. All right. So now I have it in your notes so that you guys can see it where it belongs for you guys. Okay. So here is our little picture that we just took where assets equal liabilities plus owner's equity. We see that assets, dividends, and expenses have their pluses on the debit side, whereas everything else's pluses are on the credit side. And we will use this concept to record transactions on our next page. So on to our next page. So one of the things, like I've read a lot of accounting textbooks over my years, right? And so I've been teaching since 2001. So I've been teaching for 21 years now. And so this is something I read one time and I thought it was ridiculous, but I'm going to give it to you anyway. So one way to remember which ones are debits, it says after eating dinner, let's read the comics. Who does that? Maybe Tor. And so ADE, after eating dinner, assets, expenses, and dividends, assets, dividends, and expenses have their plus on the debit side, and the rest of them are on the credit side. So what we're going to learn how to do is we're going to learn how to record transactions in the journal and the ledger. And so I mentioned that up here, the journal is the book of original entry and the ledger, the home of the T accounts. This is such an important chapter. Oh my goodness, it's so important. Okay. Okay. So after we record transactions in the journal, then we are going to post them into the ledger. So in this blank, we're going to write the word posted. Posted. And that means you're going to transfer the information from the journal to the ledger. So you're transferring it from the journal to the ledger. And that's called posting. Posting is a verb. It is the action of transferring it from the journal to the ledger. So let's do that next. Okay. So, but what we'll do is we're going to learn how to record transactions. Can't believe I even have those there. Okay. So what I did was I took the exact same transactions from page 2. So in page 2, we had transactions A through I, and now we're going to record those as journal entries rather than putting them in this table. It's still going to be the same concept though. So the first transaction was got money from owners and we did cash and common stock, but now we're going to learn how to do debits and credits. Okay. So here we are. I'm now on page 5. And so I wish I would have made this a little bit cleaner for you. Oops, what's happened? Okay, so, oh, did it do that? Okay, anyway, so what I want to do is I want to record transaction A. Stockholder invests 10,000 into the business. And so what we're going to do, cross this out. I don't want to do this. My thing isn't wanting to work and I don't know why. Okay, so go ahead and cross out that, ensure the equation still balances. And what we're going to do is we're going to learn how to record a transaction in a journal. This is a journal. And so what we do is we listen carefully. We always list the debit account first. So the debit account goes first. Whatever account gets debited goes first. So our 2 accounts that we're going to use, stockholder invests 10,000 in the business. So the 2 accounts that we're going to use are going to be cash and common stock. Cash and common stock. And I wish you guys were here so you guys could give me the answers, but I'm going to go ahead and just pretend like you're answering me. So feel free when you're watching the video to just talk to me. Just say stuff like you're answering my questions, just because it'll make me feel good that when you're watching it, you're doing that to yourself. So stockholder invests 10,000 in the business is going to be cash and common stock. Those are the 2 columns you would use in your table, cash and common stock. So the question is, I'll always ask you about cash first. Are you receiving cash or paying cash? And so the company is receiving cash. So cash is going up, right? So if cash is going up, cash is an asset and the asset is going up. So I am going to debit cash. So what I'm going to do is I'm going to put cash on the first line. And then I'm going to put 10,000 in what's called the debit column. That's where I was saying, I wish that I would have had like the word like debit right here and the word credit right here. Because when you see journal entries, you'll have a debit column and a credit column. So the way that it'll look when you're doing transactions for homework, I'm kind of jumping around a little bit, but you guys need to see this. So you'll see the journal, like when you do the journal, you'll debit and credit, and then you'll have a debit column and a credit column. There's that DR abbreviation I was talking about. Okay, so you will debit cash, and then the other account gets credited. So the 2 accounts we're using are cash and common stock. And so on the second row, pay attention. When you do a credit, you have to indent it. Debit's on the left, credit's on the right. Debit left, credit right. Did you hear me indent? I indented. And then I'm going to write the word common stock. Okay. Now, the first time students turning homework in class, they don't ever indent. They always like write everything in the debit column or something like that. And I'm like, I don't know. So we debit on the left, credit on the right. This indentation is important. Okay. Because that means that this account is credited. Accountants recognize this, meaning this account got debited and that account got credited. So that is your first journal entry. It's beautiful. It's lovely. I like it. It's there. So now let's do another journal entry. Letter B. Borrowed 15,000, signing a note payable to the bank that's due in 3 months. So we are borrowing money. We are receiving cash, and we are going to have to pay it back. Notes payable. So cash is going up because we are borrowing money. The business receives 15,000. And so the other account is credited. Okay, that's notes payable. Okay, so this transaction means that you are receiving money and you are going to have to pay it back. This transaction, you received money, but you do not have to pay it back. We financed our business through common stock. This indentation means that you credited notes payable. Okay, so this journal entry is complete. Okay, debiting cash makes cash go up. Debiting cash makes cash go up. Crediting A liability makes liabilities go up. Your equation stays in balance as long as you debit something and credit something. Your accounting equation will be staying in balance. Okay, letter C, acquired a truck and equipment, paid cash. So on letter C, we are receiving equipment of 20. Okay, we are receiving equipment of 20. By the way, if you scroll to page, I don't know what page this is, 7, you can see our account names: cash, supplies, equipment, accounts payable, notes payable, common stock, and then we have retained earnings, which we won't use. Okay, so that's how you know, like that's your chart of accounts that allows you to choose different accounts to use. So letter C, we are buying truck and equipment, we are paying cash. So cash is going down. It is not going up. If it was going up, you would debit cash, but you will not. So on the second line, you will pay cash. On the top row, you are getting equipment. I am debiting equipment. I am receiving equipment. Equipment is an asset. The asset is going up. I am paying cash. Cash is going down. Okay, for 20,000. Okay, next transaction. We are purchasing supplies on credit. And then remember the last part of the notes, it said on credit means that you're going to pay later. So we're buying supplies. Supplies is an asset. We are going to pay later. Accounts payable. So I want you to keep in mind that this transaction doesn't involve cash. I always do cash first. Like, what happened to cash? But I cannot do cash first because this transaction doesn't involve cash. One time I had a guy, he was getting ready for his final, and he's like, cash is always on the top row, right? And I'm like, not right. Not correct. Cash is not always on the top row, because if you pay cash, then you have to credit it. Okay. But on this one, no cash at all. So the two accounts I'm going to use are supplies, and I bought it on account, so I'm going to pay later. So supplies and accounts payable. So one is an asset and one is a liability. So when I look at supplies, supplies is an asset and the asset is going up. So I'm going to debit supplies and credit accounts payable. $300. Again, I wish I had the word debit and credit above the column so you could see that. And I'm sorry I didn't do that for you. And I'm only changing those colors just because I did on the first one and then I felt like I needed to keep doing it, but I'm going to stop. Letter E, that sign a contract, that's nothing. Remember, that's not a transaction. Letter F, pay off the accounts payable. Pay off the accounts payable. So when you pay off the accounts payable, you are going to pay cash and remove the accounts payable. So since you're paying cash on the second row, you are paying cash, it's 300. If you didn't know what to put there, I would rather you put question marks than to leave it blank. Because if you leave it blank, then I think that maybe you didn't know you were supposed to debit something. Every transaction has to have a debit and credit. If it doesn't have a debit and credit, then you do not have a complete transaction and your accounting equation will not balance. So this debit is accounts payable, because that's what you paid. On letter G, you are going to pay for and receive supplies. So we're paying cash and you're receiving supplies, 600. And on letter H, you're receiving equipment. And so equipment is an asset. The asset's going up. And you are paying cash. Okay. And last transaction, letter I, is nothing. Because you are not actually getting it. Oh, look, I changed it to a computer. That was smart of me. I remember it used to say lawnmower. And I was like, what am I doing buying a lawnmower? And so it should have been consistent. What did it say? Wasn't it like 1,500? That was 900. Ordered a $900 lawnmower, and I was like, why am I buying a lawnmower? And I got all mad about it. And so when I got to this part of the notes, I changed it to a computer. But regardless, it's nothing. So it doesn't matter. Okay, it would still be an equipment, but it's nothing. So do not do anything with transaction I. Okay, so the next thing I need to do is I need to post Posting is the last new topic I need to teach you guys about in this chapter, I think. And it's the idea of moving it from the journal to the ledger. So right now, if I just said, hey, Angela, how much cash do you have? And you'd be like, I have no idea. I received some, and I received some, and I paid some, and I paid some, and I paid some, and I paid some. But right now, you don't know the balance in cash. So to find the balance in cash, what you need to do is you need to post. So posting is the process of taking every single transaction and moving it to the T accounts. So as accountants, we have software that we enter the journal entries into, and then we just hit a button that says post, and they all fly to the T accounts. And it's easy. But you guys don't know like what a post button would do. So we do everything manually in this class, so you learn the process. So what we're going to do is we're going to go to the cash account, transaction A, we're going to go to the cash account, and we are going to put a number on the debit side because I debited cash for 10. So what I'm going to do is I'm going to go to the cash account, and I'm going to put a number for transaction A on the debit side. That's how you post, okay? Posting is a tedious process because you've got to move each transaction. But it also like helps you find all the balances, and you got to just keep yourself organized while you do it. The other side of transaction A was crediting common stock. So I'm going to go to common stock, and I'm going to put a number on the credit side. And then now I've posted transaction A. Like you can put a check mark next to it if you want to. So if you want to go up to this transaction and be like, done. So like put a little stamp, a little check mark, like I did that one. Now I'll go to the next one. I'm going to debit cash for 15 and credit notes payable. So I'm going to go here and I'm going to do 15, and then I'm going to credit notes payable. So that's transaction B. I debited cash and I credited notes payable. Sometimes students are like, well, how did you know which one to debit and which one to credit? I just did exactly what it said. Debit means left. I debited cash. So I went to the left side of cash, 15, credit notes payable. All right, transaction C, I'm going to debit equipment and credit cash. So I'm going to go to equipment, transaction C, 20,000, and then I'm going to pay here. All right. Sometimes students are like, do I put it here or do I put it here? It doesn't matter. I put it up there just in case because I don't know how much room I need, but you would probably be okay. I think you'd have enough room if you put it there. As long as you put it on the correct side. That's the important part of posting. So on transaction C, I needed to put it on the left side for equipment and the right side for cash. Next one is supplies and accounts payable for 300. So you guys can hit pause and you can just do all of them and then check it. E was nothing. F is debiting accounts payable and crediting cash. So this is F. I'm just putting it here so you can kind of see it. And then F 300. So debited cash, credited accounts payable. And I just checked. Debited accounts payable, credited cash. I'll make sure I get it right. Debited accounts payable, credited cash. Letter G, debit supplies, credit cash. Letter G is for 600. So letter G, 600. Letter G, 600. Letter H is 1,000. Letter H is 1,000. All those are posted. And then letter I is nothing. So now we are done posting. So posting is the process of transferring it from the journal entries to the T accounts. So now I have to find the balance in each account. So post the transaction and then determine the balance. So before I try to determine the balance, I draw a line all the way across. So any transaction that has more than one, draw a line across. Now I don't have to do it for common stock because look at common stock. It just has one transaction in there. So I can draw a line across and then rewrite the number, but I can also just double underline it because the answer on common stock is going to be 10,000. The answer on notes payable is going to be 10,000 or 15,000. But equipment has two numbers. So I'm going to draw a line all the way across. So usually the easiest way to do that is a border. And so I'm going to draw a border across, and then the balance in equipment is 21,000. And we all agree, you can see that it has two debits. So if it has two debits of 20,000 and 1,000, then the answer, the balance, is a debit balance of 21. Now keep in mind that the balance should always be on the positive side. So ADE have debit balances. ADE have debit balances because the plus is on the debit side. Okay. So 21,000 there, draw a line all the way across here. The balance here is 900. Oops. Give it a nice double underline because that's the answer. Nothing's in retained earnings, so I'm just going to leave it alone. Accounts payable, I'm going to draw a line all the way across. Now, what's the balance in accounts payable? I credited and then I debited, and so the balance is 0. So students were like, I don't know where to put the 0. You put it wherever the normal balance should be. It doesn't really matter. But if accounts payable had a balance, it would be on the credit side. So we are going to put the balance right there. And I'm just going to put it as a 0, and then I'm going to double underline it. And then on this one I got some work to do because I got to find the balance. Now, when I find the balance, keep in mind that assets increase on the debit side. So I'm going to add up all of these and subtract all of these. So I'm going to add up all of these and subtract all of these. So if you guys remember the transactions, cash went up by 10 and 15, and then we spent a bunch. So I'm going to take my calculator and I'm going to say 10 and 15 minus 20 minus 300 minus 600 minus 1,000. My balance in cash is 3,100. Then just double underline it. So at this point now, I have found transactions to create balances, and I can go on and do a balance sheet. So now I know the balance in cash is 3,100, supplies, and so on. So as we do balance sheets, we're going to start doing fancier ones as we move forward. So we're going to identify if they're current or non-current. So a current asset is one that will be converted into cash within 1 year. It's going to be used up within 1 year. So if I buy supplies, I'm going to use them up within a year. But non-current assets last longer than a year. And the best example of that is PPE. Property, plant, and equipment lasts longer than a year. If you buy equipment, it lasts longer than a year. Okay. So my current assets are cash. And it was 3,100. I just remember that from the previous page. And supplies, 900. So what I'm doing right now is a balance sheet. And a balance sheet has a who, what, when. And it looks like my total of my current assets look like 4,000. My equipment from my previous page was 21,000. So my total of all of my assets are 25,000. I would probably double underline that because I want to. My current liabilities, accounts payable, there isn't any. And so I guess the notes payable must be current. I don't remember them telling me when I owe that. Sometimes notes payable is current. It just depends on how long till you pay it off. So I only have one liability, and it's notes payable, 15,000. So my total of my liabilities is 15,000. And then my two kinds of equity are common stock and retained earnings. Common stock was 10,000 and retained earnings is nothing. So you don't have to put it on there when it's 0. I just did because I don't want you to forget that kind of retained earnings. So total owner's equity is 10,000 and total liabilities and equity is 25,000. 25,000 and 25,000 equal. So that means that I balance. Yay. Okay. So we won't do anything with the current ratio, but I'll go ahead and give you the formula. You just take current assets divided by current liabilities. And what you're doing here is you're seeing if you have enough money, if you have enough current assets to pay your bills. If we look at this business right now, it's not doing so well because it only has 4,000 and they're going to have to pay this within a year, apparently. So I would say that this business is in terrible trouble. They need to find some customers and get some money. So we won't do anything with this for a while though. So basically that's really it for this chapter. If I scroll out a tiny bit, just to show you where we're going with this, this is the accounting cycle, and this is what we're going to learn how to do between now and chapter 4. So you are going to look at documents and record journal entries. We learned how to record journal entries today, and then you post, and we learned how to do that today. So these are the two things that we learned today. And then eventually you're going to prepare financial statements. Like, so you're going to do trial balances, adjustments, and adjusting entries. We're going to learn this in chapter 3 and these two in chapter 4. And then preparing financial statements, we already know how to do that. And then we'll do closing, and we'll learn that in chapter 4. So this is just kind of where we're going. I just drew that picture. And then the last page is just some definitional stuff to kind of help you with your homework. Like, what is accounts payable or what is accounts receivable? And so I give this to you just to help you along with your homework. So that's it for chapter 2. And I will come back to you for another chapter. And I hope you guys are doing well. Thank you. You're ready to do homework, and I'll give you a preview of the week with some previews on your homework. So, all right, I'll talk to you soon. Thank you.